If you think $50 is too small to matter, that belief will keep you broke longer than a low salary ever will. Wealth does not begin with large amounts of money. It begins with the decision to build a system. When someone earns modest income and can only invest $50 or $100 per month, the strategy must change. The focus is not dividends. The focus is capital growth. Dividends come later. If your long-term goal is $3,000 per month in dividends, the real target is still $900,000 in capital. But you do not think about $900,000 on day one. You think about reaching the first milestones. $1,000, $5,000, $10,000, $25,000. The early stage is about building momentum. Momentum is psychological and mathematical. Start with broad market exposure. When contributions are small, diversification must be simple. Instead of buying random individual stocks, start with broad market ETFs, such as Vanguard Total Stock Market ETF, VTI, owns virtually the entire U.S. stock market, including large, mid, and small companies. iShares Core S&P Total U.S. Stock Market ETF, ITOD. Similar exposure to VTI with very low fees. These funds include technology, healthcare, consumer goods, financials, industrials, and energy automatically. Road market ETFs own the entire market, like S&P 500 exposure. Vanguard S&P 500 ETF, VOO. SPDR S&P 500 ETF Trust, SPY. iShares Core S&P 500 ETF, IVV. These track the S&P 500, which represents 500 of the largest and most profitable U.S. companies. When you buy one of these, you automatically own companies like Microsoft, Apple, Johnson & Johnson, ExxonMobil, JP Morgan Chase. Global exposure. Vanguard Total World Stock ETF, VT. This ETF gives exposure to both U.S. and international markets in one fund. If someone wants simplicity, this is as close as it gets to owning the world. Fractional shares through low-cost brokerages. Fractional shares allow you to buy a portion of a stock or ETF instead of a full share. If a share costs $400, you can invest $50 and own part of it. This makes it possible to start with $50 or $100 per month without waiting to accumulate larger sums. Consistency is everything. Automate immediately. Manual investing fails when income is low because discipline feels harder. Set up automatic transfers. Even $50 per month invested automatically removes emotional decision-making. You invest whether you feel motivated or not. When your portfolio is $1,000, a 4% dividend yields $40 per year. That does not change your life. Trying to maximize dividend yield early slows growth. Focus on total return. Growth assets accelerate capital formation faster than high-yield slow-growth stocks. Increase contributions before chasing returns. If you invest $100 per month at 8% annually, after 5 years, roughly $7,300. After 10 years, roughly $18,000. After 15 years, roughly $34,000. That alone will not reach financial independence. The real power comes from increasing contributions. If you move from $100 to $200 per month within 3 years, your long-term outcome changes dramatically. At low income levels, your biggest asset is not your portfolio. It is your earning potential. Learning a skill that increases income by $500 per month is transformational. Use this phase to improve job skills, learn high-demand digital abilities, seek promotions, build side income streams. Capital accumulation accelerates when income expands. Your first real target is $10,000. When your portfolio crosses $10,000, an 8% return equals $800 per year. Dividends may reach $200 to $300 annually. Growth becomes noticeable. At this stage, your investments begin to generate visible growth. But market returns alone will not take you from $10,000 to $100,000 quickly. If you continue investing only $100 per month, progress will be slow. However, if you increase contributions to $300 to $500 per month through income growth, the timeline compresses dramatically. For example, $400 per month at 8% annual return. After 10 years, approximately $73,000. Add income growth and raises six figures becomes realistic. Instead of hoping income rises, build a rule. Every raise increases investment contributions. If salary increases by $300 per month, at least $150 goes directly to investing. If side income grows, a fixed percentage goes into the portfolio automatically. This prevents lifestyle inflation from stealing momentum. During the climb toward $100,000, complexity remains unnecessary. The structure can remain 70% broad market exposure, 20% growth sectors, 10% defensive or dividend growth companies. For instance, Procter & Gamble, Johnson & Johnson. These companies begin forming the base for future dividend income, but they are not yet the main focus. Handle market downturns correctly. At $20,000 or $40,000 invested, a 20% market drop can feel discouraging. You may see several $1,000s disappear temporarily. When contributions are ongoing, lower prices help you. You are buying more shares at discounted valuations. Selling during downturns resets progress. As your portfolio grows, new temptations appear. Trading frequently, chasing trending stocks, moving in and out of markets, trying to time corrections. None of these accelerate wealth consistently, where you should be near $100,000. If disciplined, portfolio value, $80,000 to $100,000. Annual growth at 8%, $6,000 to $8,000. Dividend income, $1,500 to $3,000 per year. Now dividend income begins to matter psychologically. You see money arriving without extra effort. Reaching $100,000 is not the finish line. It is the moment compounding becomes visible. At $100,000 invested, an 8% annual return produces $8,000 in growth. That is $666 per month generated by capital alone. Now money starts helping you build money. But this is also where many people slow down. Instead of focusing purely on growth, gradually introduce more dividend growth companies. Examples that can serve as long-term income anchors include Johnson & Johnson, Procter & Gamble, Coca-Cola, PepsiCo. These companies provide moderate yield today, but increasing payouts over time. The shift should be gradual. Accelerate from $100,000 to $300,000. This is the most powerful stage of the journey. If you invest $1,000 per month at 8% annual return starting from $100,000, in 10 years, you approach $350,000 to $400,000. If contributions grow annually, the outcome improves significantly. Now returns from capital begin matching or exceeding contributions. At $300,000 invested, 8% equals $24,000 per year. This is where many people realize wealth is mathematically inevitable if discipline continues. At $500,000 invested, 8% equals $40,000 annually. That is more than many people's salaries in the early years. As you approach $700,000 to $800,000, the portfolio structure slowly shifts toward income readiness. More dividend growth exposure, more diversified income sources, less speculative allocation. The goal is to reach $900,000 with blended yield near 4%, strong dividend growth component, balanced sector exposure. At that level, annual dividend income reaches approximately $36,000. That equals $3,000 per month. Wealth is not built in one decision. It is built in thousands of consistent ones.